Good afternoon, everybody, and welcome to the ActivTrades Monday Market Matters webinar for 19th of February. It's Paul here, and today we're going to talk about how to best use moving averages in our trading. Great to be here with you. Great to have so many of you here joining us today. I would appreciate it if you'd be kind enough, those of you here joining it, just to be able to confirm that you can see the slides and hear my voice. Just make sure that we have the technology working with us rather than fighting us. If people in the room could just quickly in the chat box confirm that, that would be fabulous. And then we'll be sure to sort of start with our main feature for today. Excellent. Thank you, everybody. Okay, super. So as always, okay, we're just engaging in regulated activity. We just start with a quick risk disclaimer. You can take a moment just to read that and make yourself aware of it. Just remember that trading with margin does involve risk, and that ultimately you are responsible for your own trading decisions. We'll talk about today, we'll always talk about the news with Monday Market Matters, but we'll talk about what are moving averages. I appreciate that we always have a broad range of experience of traders who join us for our sessions, from complete beginners to those who are very experienced. So there will always be something for the new traders, but also something that hopefully the sort of more experienced traders can take away and utilize as well. And what we'll look at are things like what do we need to be aware of when using moving averages, and how can they benefit traders, and also what are the sort of disadvantages we want to sort of be aware of and avoid. And then, as always, we will sort of check out live markets and see what's going on as we look to start what would normally be into the sort of the cut and thrust of the main US session for the week. But of course, today we have President's Day in the US, which will effectively sort of negate the vast majority of equities trading in the UK. But more of that in a little bit. Before we start, just a quick reminder, those of you in the UK or in London, or maybe you travel from further afield, that ActivTrades will be sponsoring the London Trader Show on Friday, the 8th of March. We'll have a stand there, we'll have a few speakers there, including myself, okay? And that will run all day in the Novotel London West. And you can get a ticket for that. And if you use the code ActivTrade69, that will actually help you get a complimentary silver pass worth normally £69. As I said, I'll be there talking about all about trading key reversals there, and I think I'm on there about sort of 10 o'clock in the morning, sort of early doors. So by all means, come along and join us, okay? Vikesh and the team and myself and a few of the other speakers will be there. So by all means, come along and see, and we'll be happy to sort of engage with you and have a chat. And I look forward to speaking to some of you there. For those of you who don't know me, my name is Paul. I've traded for many years, okay? Traded for funds, traded for clients. Primarily, okay, I like to trade trends for my longer term trading, and I tend to trade sort of reversals and mean reversion for shorter term intraday trading. Both types of trading, can also utilize moving averages, so I'll be sharing some of that insight with you there today. So as always, we've been running Monday Market Matters now for a while, and our whole aim is to help traders start the week in the right frame as we prepare for normally the opening of the US market. So every Monday, London 2 o'clock, we basically will be looking at a quick look at the news, okay, what's coming up. Main piece on the education, which is what we'll talk about moving averages today. We'll always have a chat about the ActivTrades platforms and tools that are available to you as a client. And we always have a little look at the live market to the start of the US session to see how they are setting up. So there's always plenty for us to discuss, always plenty for us to talk about and cover. So let's start with a look at the at the news, okay? And for those ActivTrades clients, what you'll find is that there's a fabulous team of analysts sort of bringing out hourly, daily analysis across all sorts of asset classes and instruments that you can make yourself available to, and there's plenty of great analysis you can tap into. And what they will also do is they will also at the start of the week they will send out a short email with details on not only the major news but also sometimes their insight and their analysis of that. So it is well worth making yourself available for that. Okay, as you hear me say every week, I don't expect brand new traders to be able to maybe understand and analyze the economic data, but it is important to know when it is coming out. Okay, and you can find that on an economic calendar, of which there is one on the ActivTrades website and elsewhere on the internet, so that you are aware of when these major pieces of data are coming out. And last week was a very real very heavy news, economic data news week, both in the US and in the UK and elsewhere. And whilst we have a good bit of news coming out this week, it will not be as not as heavy as last week. And when we look at the live markets towards the end of our session, we'll see the impact of that data, how it played out in the markets. But as I said, today we have the President's Day holiday and Family Day holiday in Canada, so that invariably have a big impact upon trading, across the sort of US markets and across the US time zones, shall we say. But when we move into the remainder of the week, well, of course, most of those traders will return tomorrow, and we have tomorrow probably kind of whilst we do have the policy meetings, minute meetings from the Royal Bank of Australia from their recent meeting, probably what most people will be looking at is the Canadian inflation figures, Canadian CPI, all right, and be interested to see what is the trajectory there for Canada. Probably the biggest piece of news I would suggest for this week will be the Federal Reserve on Wednesday, the 21st. They publish their monetary policy meetings from their recent meeting, and so traders will be keenly sort of digesting that data to sort of once again sort of understand whether there's been any change in narrative or trajectory for the Federal Reserve's policies. We also have Australian PMIs, and that's where we get into in terms of on Thursday we have the kind of French, German, and UK. All right, they have the flash services and manufacturing PMI. Their data will be coming out, and also in the afternoon, or certainly the afternoon for European traders, you will also have the US, the US flash manufacturing and services PMI. And then on Friday, we have German GDP figures and the German IFO Business Climate Index. So there is a bit of news coming out this week, but as I said, it's not as heavy, as hard-hitting as it was last week. But I think definitely the Federal Reserve monetary meeting minutes on Wednesday, that will be the sort of, let's say, the main piece of data that traders will be sort of looking at. We also have, in terms of equities, we have NVIDIA. I think it's NVIDIA have their earnings. They're the last of the sort of magnificent seven, as they're so called these days. They're reporting their earnings. I think that's tomorrow. And of course, the NVIDIA, the sort of price action on that has been quite astounding, in 2024. And some might say that has had a huge impact on just overall markets. Maybe just holding up all markets. And so lots of traders will be very keenly aware to see, what kind of earnings NVIDIA posts, and most importantly, how do the markets react to that news? That's what we'll be particularly looking at and interested in. So plenty to digest, and as I said, it is important to know when that economic data is coming in, and I do stress that every week, ladies and gentlemen. The reason is because it is enormously important, especially if you're at the start of your trading journey. So after having looked at the news, let's have a chat about our educational piece for today, which is all about the best ways to use moving averages. Now, it would be kind of interesting to see for the people who are joining us here live today for our session, how many of you presently use moving averages in your trading? If you could just put that in the chat box, whether that's something that you utilize, and if and how you utilize, that would be interesting to sort of see what people's experience has been of them, if they've used them at all. But what we tend to find is that, as the slide says, for many new traders, moving averages, they are a simple and popular indicator. And people might ask why they're popular, which we will have a little look at why in the next few slides. But what we'd probably suggest, and this is probably based upon my own personal experiences, okay, of trading and coaching traders, okay, for many years. Many new traders would use them inefficiently in their own particularly to them. So Philip says, I try to avoid using too many indicators, so not at the moment, and that's absolutely fine, Philip. It's there are many different ways to engage with markets, and it's always great to hear how other people do. And I would agree with you in that the kind of less is more when it comes to indicators. All right, new traders, sometimes I see they send me their charts, and there might be 10, 15, 20 different indicators on the charts, and then they wonder why they're struggling to make decisions. It's very much a case of less is more. But so thank you for that, Phil. But what I'd say is in this session, we're going to take a deep dive into moving averages and discuss how traders could possibly use them more efficiently in their own trading. And maybe one or two of these ideas will be new to you. Maybe one or two of these ideas will just give you a little bit of insight into how you could use them alternatively wise, and might sort of just give you a little bit of help at sort of, let's say, seeing them in a fresh light. So I think it's fair to say that, as the slide says, many new traders will start their trading journey with using moving average indicators, and the question might be is, well, why is that? What is it that makes them popular? What is it that has traders sort of drawn towards them? And I will explain that over the next couple of slides. For starters, my belief would be they're popular because they're a visual trading tool, and still to this day, most traders are male, and most males are driven by visual cues. And I will leave it to other people to sort of debate whether that's a good or a bad thing. It's just naturally the case the way it is. But one of the other reasons is it allows traders to view smoothed out data. It gives traders an opportunity to help believe that they are making sense of what might well appear to be volatile and erratic price action movements when they're at the start of their trading journey and just trying to grasp and understand what is actually occurring on markets. So, here we have, just a very simple chart there, and that has effectively, a 10-period moving average. And for those of you who are very, very new to trading, really, it is a simple line that is drawn on the chart where invariably every time a candle or a bar closes, in this particular case, the indicator will effectively take the last 10 closes. Okay, take the data from the last 10 closes, define an average of that, and then print that on the actual chart itself. Okay, as you can see there, because it's only 10 periods, what we see is that the moving average is very, very close to the price action, and as we'll look over a couple of slides, that will depend upon the sort of the number of periods you include in your moving averages. So that's how they are created, and there are lots of different ways, or lots of nuanced ways that people might particularly like to look at using moving averages, and I'm going to try and sort of talk a bit about them today as we go through our session. My view would be that moving averages get a little bit of a bad rep these days. Okay, they get a little bit of bad rep because, as I said, lots of people start their trading journey with moving averages, but they don't use them in the correct way, and so they move away from them. Whereas actually, moving averages can be a very useful and helpful tool if you understand how best to use them, and they can be very helpful for new traders in terms of just clarifying the direction of the market, the momentum of that market, and also the strength of the trend, okay, helping identify that there is a trend and exactly how strong it is. And what we'll do is we'll delve a little bit more into those as we go deeper into our session today, so that we're in a position hopefully to understand how moving averages can actually help us and improve and sort of develop and evolve as traders in our own journey. So very often when it comes to moving averages, the first question lots of people might say is, well, what type of moving average should I use? All right, as I said, there's lots of different types of moving averages. They all have their nuances, and you'll find that there are, yes, there are many different types of moving averages, but you'll see there's several options that are used. Most people will work on either using a simple moving average or an exponential moving average. So, simple moving average is effectively, as we sort of just said there, namely that when every time a candle closes, they will collect let's say, the last 10 periods, if you're using a 10-period moving average, last 10 closes, add them, or take an average of them, and then basically print that on the chart. Whereas an exponential moving average, what they are looking to do is they add more weight to the latest data. So the latest data, the more recent data, they add more weight to it. And actually what that shows up is, in terms of difference between simple and exponential, is that in simple terms, it's speed, okay? The speed at which they change. Now, how does that particularly look? What does it look? Well, as I said, exponential moving averages, they give more weight to the most recent price action. So when price changes direction, the EMA recognizes this far sooner than a simple moving average. However, all right, the simple moving average, which moves slower, that will keep you in trades longer when you are trying to follow a trend. And as an example here, which I'm hoping that you can see in this chart here, what we have is, let's get up the drawing tool here. We have a 20 EMA here, which is our dotted blue line. And what we can see is that turns faster than the 20 simple moving average, okay, the full blue line, at the price at where market reverses. You can see actually that as we reverse here, then invariably we see the EMA turns faster, okay? The EMA turns faster. And so, that for some traders, okay, for the way they trade, EMAs will work better than simple moving averages and stuff. But actually what we're looking at doing is understanding that, there may well be a trade idea in there, okay, if you're able to look at the difference and understand the difference between EMA and simple moving averages. So, as I said, and there are other ones, there are weighted ones, there are, lots of other different variations of them. But what we're interested in doing is actually just seeing how can we utilize them the best for our own trading decisions. So when it comes to moving averages, I tend to follow simple moving averages, okay? That doesn't necessarily mean that they're much better than exponential. I just tend to follow simple moving averages, and they work perfectly well for what I utilize them for, but more of that later. The next question when it comes towards moving averages is that people will talk about what is the best period moving average for me to use. All right, and it's a bit of an age-old question, and one that it is constantly debated. And trust me, I have been in trading conferences, trading meetups, etc., where traders will quite happily sort of debate over the nuance of which type of moving average and what's the best period, and we'll happily sort of debate that till the cows come home. As the slide says there, you could spend your life testing combinations, and if that is the way you'd like to operate, you're very welcome to do that. Whereas my suggestion is that you invariably just stick to the commonly used moving averages, all right? And why with that? Because I think at the start of your journey, you should keep it simple. And also what we find is that they become a bit of a self-fulfilling prophecy for the way they operate, and more of that in a moment's time. So what you'll find in terms of periods of choice for moving averages, the very popular moving averages, they are usually things like a 10-period moving average, which is used for short-term trading, or a 20 or 21 period moving average as a filter for the short-term trend, and I myself use one of those. Then a 50-period moving average, okay, which is ideally used for the medium-term trend, or can be used as a definition of fair value. And then we have longer 100 and 200 period moving averages. And I know traders will use even longer ones, which are used for identifying the long-term trend. So there, as I said, you could spend your whole life trying to curve fit and find the single perfect moving average for every instrument that you trade and engage with, and maybe that particular, that kind of excites you at the thought of that. But generally, as I say, I generally tend to use just some very standard, simple ones that allow me to give me an indication of what I need to know, okay, in terms of supporting my decisions on trends and trade direction and trade strategies, which we'll talk about in a couple of slides' time. So, as I said, here we go. I just use a blue 20 period moving average, which you'll see on my charts. Then I have a red 50 period moving average and a green 200 period moving average. And as you can see, let me just clear this drawing here, is that the blue, is invariably sort of, much closer to the price action. It's almost like the short-term trend. The red 50 is the medium-term trend. It's the sort of the definition of value. And the green 200 period is, it is basically the sort of a longer-term trend. And that's what I particularly look to utilize them there for, okay? And that's how you will always, when you see my charts, you'll always see, at least those three. Sometimes I might have one or two others on for specific assets or specific trade setups, but as my kind of, let's say, my core, okay, my core chart setup, I will have those three moving averages and fractals, which are these, you can see these little applets there, okay, and that's enough for me to work with in terms of being able to make my trading decisions. As I think it was Philip said earlier, lots of people do put on many indicators, and sometimes there might be 15 to 20 indicators on a chart. I personally have always think that less is more. You want to keep it simpler, and that is, if you want to, use simple tools, moving average can help you with that. So, if we're looking at what type of moving averages do I want to use, and if we want to understand what's the best period, moving averages, well then, that leads us to the next question, which is very well, how can I actually use them? All right, it's all well and good identifying, describing, and talking about, but ultimately we're getting to a point where, all right, well, how do I use this in my trading? Okay, how do I utilize this to actually help me trade better? So that's what we want as the main crux. And so let's have a little look at a couple of ideas of how you could use moving averages in trading. And as I said, I'll provide some of my own insight into how I've used them and what I've learned myself, okay, from those particular experiences. So the first possible way, okay, that people utilize them is what's known as a moving average crossover. And this is a very popular trading strategy with new traders, right? You basically place a trade in the direction of the trend when you see the faster moving average crosses a slower moving average in the direction of the cross. And people are immediately attracted to them because it works very well in trending markets, but what they don't realize is that it works poorly in consolidating markets. So many new traders, their experience might well be that they see a chart like here, where invariably, let's just get the old drawing to, they look to buy that market when the faster 20 period moving average crosses the slower 50. So they'd be looking to buy it here, and then invariably they get out, they close that position when the faster moving average moves beneath the slower moving average there, okay. And so invariably, if they've bought here and then they're closing their position, selling out their position, well then they can see that the sort of profit between where they bought and they sold is significant, and then invariably they fall in love with a moving average crossover. And the thing is that it does work well in trending markets, but pretty much everything works well in a trending market. That's the thing. When you're at the start of your trading journey, you may not realize that, but when you're in a trending market, everything works well. but you'll have heard me say it many times, the challenge you've got is that markets only tend to trend 20 to 30% of the time. The challenge you have trying to use moving average crossovers, okay, is that invariably once you are into a kind of consolidating market, well, you're buying here, selling here, buying here, selling here, buying here, selling here, buying here, selling here. Okay, so once markets are kind of going sideways, consolidating, what happens is that you get caught up in the chop, you get whipsawed right in the chop between those moving averages. So this is what happens is then your new traders, they see moving averages, they think, oh, fabulous, it looks great in a trend, but what they don't realize is that they will get, they can get cut to shreds trying to trade in a consolidating market when a market's going sideways, which is why it's important to understand, the market you're trading, what environment is it in? Is it trending? Is it consolidating? Is it transitioning from one market environment to another? These are things that are important to understand, because as I said, if you're going to try and trade moving average crossovers, you only want to basically be able to use them in trending markets because they don't work very well at all in range band consolidating markets. And remember, I said markets tend to only range for 20 to 30% of their time. That's the thing you have to take into account. What you will quite often see if you watch, financial media, is that they will use, popular versions of moving average crossovers, namely what you will sometimes hear them call the death cross, which is, a very bearish sign, which is where the 50-period moving average crosses the 200-period moving average here, or a golden cross, which is a bullish sign, where the 50-period moving average crosses, to the 200-period moving average to the upside. The challenge you have with these, is that they sound great on financial media when you might be watching that on a device or on TV, etc. It sounds great, or it sounds ominous, but the reality is, as in this particular case here, moving average crossovers, they not only do they only really work well in trending markets, but they're very lagging, especially if you're utilizing sort of higher period moving averages. So in this particular case here, let's just clear these down. In this particular case here, this was where we had a death cross, namely the 50 crossing the 200. But if you were looking to sell the market, when the 50 crossed the 200, you would basically see very quickly that invariably the market had already finished its downtrend and was actually starting its uptrend. That's the challenge with it and stuff. So it's a case of it that does not particularly work well. As I said, it sounds good. It looks good on financial media, but it's not really an effective way to sort of really to trade. And this would be my personal belief. So if moving average crossovers are not necessarily the best way for us to use, let's look at some other alternative uses for moving averages. One of them can be for using it as a trailing stop loss. All right. So this could be where we might have an initial trade, an initial position, but this is where actually our initial stop only gets moved when it gets moved behind a particular moving average. So as it says, as you can see there, it is a fine example of where moving average can help you have a simple way to trail your stop in order to stay with winning trades for longer. So sometimes new traders, they struggle because they snatch at their profits very quickly, and they whilst they want to stay with a trade, they find it difficult to find a simple way to be able to stay. And being able to trail, being able to trail on your stop loss can be a very simple way to do that. So, let's say in a particular case here, perhaps we were trading a breakout here. Once price had broken out of this particular level. And it might be a case that our stop is placed beneath the 50-period moving average, and every time the price moves, well then our stop loss gets moved with the moving average, and it trails just behind that moving average until price closes the other side of that moving average. And what that means is that when we do get good trends, it gives you the opportunity to stay with a winning trade for far longer than you might have done if you had just used either a simple target or a tighter stop loss, etc. So these are the things that understanding your particular style of trading becomes important, because for many people that is actually a nice simple way that they can use a moving average and help them stay with the trade, and it becomes objective in terms of their stop loss does not move until the actual moving average does move and update, and that provides almost like a simple rule that they can follow as a way and a means to basically to stay with their trades. One other way that we can use moving averages, and this is a way that I myself like to use moving averages, that is we start to use moving averages as areas of dynamic support and resistance on your charts, okay? And one of those reasons I said for using just simple popular moving average periods, so 20, 50, 200, is because there are it becomes like a self-fulfilling prophecy, okay? By their very nature, what you will find is that there are lots of traders, lots of trading systems that will place their trades around popular moving averages. And what this does is this provides an area or an opportunity to join a trend trade on one of its particular pullbacks. So remember what I was saying, I have a blue 20, a red 50, green 200. You'll see that there are quite a lot of very, very simple buy and sell programs that would invariably, sell. The market will sell once price comes up to the 20-period moving average from below. Or on the flip side of it, if we were in an uptrend, they would basically buy the 20-period moving average as price comes down to it. Just very, very simple buy and sell programs that just operate in the markets. And as I said, what we see in here, and hopefully this is a good example, is that the 20-period moving average, price has been in a downtrend, price pulls back, but then what do we see it doing? It's bouncing off the 20-period moving average. And when you combine, a pullback in a trend with a moving average, and in this case, bearish rejection candles for price action, well, that in itself is a very simple way to start to identify trade setups. Okay, and so this is one of the particular ways that I myself like to use moving averages, is that they are great opportunities to be used as dynamic. And the reason that dynamic support and resistance is, of course, they're constantly moving and being updated. That's what makes them dynamic. But as I said, you start to get confluence of events. And those of you who've joined us for our sessions in the past will know that I will constantly talk about, you want confluence of events where 2, 3, 4 things come together in one time and place. That is what gives you a trade setup. And so things like, in that case, you're in a downtrend, price is pulled back, it's hit the 20-period moving average, it is put in this case, like bearish pin bar or a bearish rejection candle, bearish engulfing candle, etc. That in itself, there I have a confluence event that gives me a good opportunity. It's a good simple place for me to join the existing trend as it looks to re-exert itself and continue it. In this case, it's moved down. So as I said, using moving averages as areas of dynamic support, that is one of the ways and places that I will actually use moving averages myself, and I find that very, very simple, very helpful for me, in terms of being able to get into trends. Along with that, and one of the ways, and another way I would particularly use is using the 20-period moving average as an early indication that of a trend change. So, as the old trading adage goes, the trend is your friend until the end when it bends, and with that, the 20-period moving average can be a very useful tool to help you confirm that a trend is over and that a new trend is about to basically exert itself, all right? And so what I talk about is always look at how price reacts to the 20-period moving average after recent highs and lows, or after recent reversal patterns. That in itself can be the basis of a trading strategy all of its own. So in this particular case, price has been an uptrend, and we can see here that actually, at this particular place, price, the 20-period moving average, the blue 20-period moving average has been support, and it's supported, has worked up, and what happens here though is we put in what's known as a double top there, which is a reversal pattern, and then we see that the 20 has not acted as support like it did in the others where price bounced off it. Actually, what's happened is price has basically traded through that 20, and this is where we have seen a flip. Okay, we have seen a flip from where price has been support, or rather the 20 has been support. Now what we see is that, see how, and I'm just going to clear this down to make it just a little bit clearer for everybody. Now what we see is, the 20-period moving average, which is sort of moving nicely up, has now started to turn. Okay, it's flipped, and look at the price. Look at how now the price is basically, it can't close above the 20, and not only that, the 20 is starting to, the 20-period moving average is starting to roll over, starting to turn over, and as I said, we can't close any higher. We can't close any higher, and if we can't close higher, well then, where is price more likely to go? If we can't close higher and we've had a reversal position and we're now forming a lower high and we can't close higher, we can't seem to go any higher, where is price most likely to go? The price is most likely to go down, all right? And so this is why the 20-period moving average, okay, can be a very simple but very useful early indication of a trend change. Remember what I was saying, once again, confluence of events, all right? 2, 3, 4 things coming together at one time place. We have had, in that particular example, we've had, a double top reversal pattern. We have then basically crossed the 20. The 20 has got flipped from being, pointing up to pointing down. And now actually look at that, we can't close above it. And actually we're putting in bearish rejection candles off that 20. That's just telling us that the higher probability move is to the downside. And so we would want to position ourselves accordingly. Namely, if you've been long, well, you should be getting out of that long. If you've been sat on the sidelines, you should be getting ready to go short, and that is one of the ways we can utilize it here. And that's it's a very simple way that we can work moving averages to help us in our analysis and also in our trade decisions. So before we sort of switch across the charts, just a quick conclusion, namely that, yes, I think it's fair to say that, we are going to have an interesting year in markets ahead of us. And I hope you will join us here on Monday Market Matters to sort of partake with that as we go through this interesting year. When we look at moving averages, they are a popular trading tool for new traders because they are a visual indicator and help smooth out data. And sometimes that leads to maybe them getting a little bit of a bad rep, but they can be enormously useful and helpful tools for our traders and for trading decisions. It's important to understand whether you're going to use an exponential moving average or a simple moving average or weighted or whatever. As I said, I just use simple moving averages, nice and simple. Don't need to complicate things any more than they need to be. I also personally believe it's best to use, let's say, common period moving averages. So I'll have a 20, a 50, and 200, okay, because they become self-fulfilling prophecies. As I used for them in trading, generally I would suggest avoid using moving average crossovers for your trade entry signals. Remember, they work very well in trending markets, but then everything works well in trending markets. They tend to struggle when they're into consolidating markets, okay? So, you might use moving averages, crossovers, but not on their own. They might be as a small part of an overall trading method. However, moving averages are useful for helping you confirm trends and the momentum within those trends. They can also be used and very helpful for confirming reversals in markets there again. They can also be used as a guide, okay, on where to place trailing stop losses if you want to find a way to sort of stay with your trades longer, and also as a place to enter into trending markets when we utilize them as either dynamic support or dynamic resistance. So without that, let's go move on and have a little look at live markets and see how they are being particularly playing out. Before we do, just a reminder that we're back next Monday, 26th of February, 2 o'clock London time, and next week's main session will be on what asset class should I trade. All right. So invariably, we'll see that lots of people will trade FX, some people trade indexes, some people trade equity, some people trade fixed income, some people trade crypto. And it's about trying to help new traders understand, well, what asset class should I actually trade? What one should I actually be focusing upon? So I hope you'll join us for that. And as always, if you've got any questions or comments or thoughts or feedback, or there are topics that you'd like to see us cover on Monday Market Matters webinar, then you can get in touch with us. You've got the English desk number there, 0207 6500 567, or you've got the email, englishdesk@activetrades.com, and you're very welcome to email your thoughts there. So if you just bear with us for a moment, what we'll do is we will switch across to the ActivTrades trading platforms, and we will go through them and have a little look at seeing how markets have been today. I suspect very quiet based upon the fact that it is the President's Day in the US. But we'll also look at sort of see, what and how moving averages can help us as we work our way through. So just bear with me one moment, and we'll switch across to the charts. Okay, so I'm hoping that you can still hear my voice. I'm hoping that you can see my charts. So what we'll do is I'll just do a bit of analysis of their markets themselves, okay, and we'll talk about give you a little bit of insight from that, but also having a look on based on what we've just talked about here. So whenever I'm looking at FX markets, I'm always starting with the dollar index. Okay, always starting with the sort of the dollar index to see how that plays out, because I want to understand what is the sort of the strength and direction of the US dollar, because that allows you to sort of give you a better idea of how to trade the majors. And so this is a weekly chart, and let's just draw this up. Remember what I was saying at the start? We had a lot of data out last week for both the UK, but more importantly for the US. And lots of traders, myself included, were hoping that the data last week would give us some clear indication of, let's say, the sort of narrative and the future trend, if any, for the remainder of this Q1 of 2024. We've got about sort of 5 weeks, maybe 6 weeks left here, and so if I look at the weekly chart there, that candlestick there, to me, that's not giving me, a huge amount of clarity, in the sense of, I look at that as there's a bit of a broadening formation. There's a lot of, whilst there's there's a body, there's also a lot of wick to the top, and there's a lot of wick to the bottom. That, to me, is just giving me an indication of it's more of a kind of a little bit of indecision, and maybe this week's FOMC meeting minutes might give us a little bit of a clue. What I would probably just take up on, though, is that we still did close above the weekly 20 period moving average. Okay, so that would have if you put a gun to my head, I'd say that would be forcing my kind of bullish bias there, all right, to maintain. Certainly when I go down to the daily chart, okay, this is the daily chart here. Let's just push in the daily chart here. What we saw here was well, let me just move it so we can just see a little bit more here. Okay, just yeah, push. Let's just look at this. What we had here is basically price was going sideways. All right, price was going sideways, and I'm hoping what you can see is that price was just basically pivoting around that 20 period moving average, wasn't it? But then what we saw was that the moving average, it topped out, it rolled over. Remember what I was saying here? What we had was price broke beneath the 50 and closed, and then it pulled back up into it. But now the 20 is now a roof, isn't it? It's a roof. We're beneath the 50, and then bosh, off we go. You can see that move, how that comes. We pull back. Okay, we pull back to the 20, and we bounce off it again and drop all the way down there. Okay, and that's just just looking at that using the moving averages. What we find here is we pull up and we get above the 20. Look at how the 20 acted. The 20 acted as dynamic resistance there, but then actually it starts to be resistant, and then it flips and it flips from being, resistance to support, and then we can see price start to turn around there, can't it? And then we see price push its way up, and then we can see, we've gone pretty much sideways for a couple of weeks there, just really pivoting around that green 200 period moving average there, you can see. And what we saw was here, if you look at that 20 period moving average, okay, which is now above the 50, is now acting as dynamic support, and price pushes its way up. Comes back down to the 20 here, but it can't close beneath it, and it pushes its way back up. And then we're falling down here, and I would suggest that, if we bounce off here again, that would be very bullish for the dollar there. So just even very quickly there, we can just do a little bit of analysis just using price and simple those moving averages and looking at how price interacts with those moving averages. Okay, you can take your time, you can work that out, and as I said, just look, using that as the moving averages as dynamic levels of support resistance, looking about how those moving averages can help confirm the sort of the end of a trend, the reversal of a trend, the start of a trend, or the continuation of a trend. Just understanding that can be enormously helpful there, we can see. But that's telling us there that that dollar this year is still remains strong. All right, that is, we're still bullish the dollar itself. And so, we can utilize that when we look at other charts. So, for example, here, the dollar Canadian dollar on the weekly chart, what I'm actually interested and intrigued in here is, if I just go a little bit bigger, is that, we can see that price tapped out again a few months ago, back October, big bearish engulfing candle, and price dropped its way down. But price this year has pulled its way back up to we can see there's the 50 there and there's the 20. But just look at the price action there. The price action there, it can't close above the 50 and the 20 there, can it? It pushes up to it. It's quite happy to push up to it. But every candle is almost like a rejection candle, all right? It's just rejecting, and that's kind of just a bit strange, there, isn't it? So if it can't close higher, where must it go? Where's the more likely direction of travel? And that direction of travel would likely be that actually we're more likely to go to the downside. If it can't get above and close above the 50 and the 20, well, then I think the likelihood of the direction is more likely to be onto the downside, and that's what we're particularly looking at there. Okay, that's what we're looking at, and what you can also find is when the moving averages and the price are all very closely sort of coiled up together, that is almost like the calm before the storm, right? It's kind of everything has gone from sort of expansion, we're now compressing, and then we're expecting the next expansion, and so. Because in this particular case, because all the wicks to the top, you're more likely to expect that there's a higher probability of price would move to the lower downside, and we just have to watch and wait and see how that particularly plays out over the next couple of weeks. But as I said, just using moving averages and price to give you just a little bit of an indication of what's going on. And Aussie against the US dollar has kind of been interestingly doing that. So if we look at there, what we had here, so just starting off here, is price was pushing its way up, and we can see the green 200 period moving average. Price was rallying around it, pivoting around it before we pushed away from it. Then we came back down to that 200 period moving average, and we acted as support there before price pushed away. And then when price kind of came back down, it sort of squirmed a little bit there between the 20 and between the 50, but it came down to the 200. Okay, and we can see that there's just lots of periods where price is just pivoting around the 200 period moving average. That's what we're seeing there. And fun enough, when we come back here, this is what happens, is that we are literally bouncing along the 200. The 200 is acting as dynamic support. Lots of wicks. All right, lots of wicks up there to the north side. Okay, so it's no surprise to see that ultimately we push lower, having provided all that kind of resistance to the north. We push a bit lower, and now we're back up. We're coming back up towards 200. And from where the 200 was acting as support here, you have to look at it. Is it now going to act as resistance there? And will that pin price? Any kind of move up on Aussie against dollar, will price just pin it there? Okay, so as I said, hopefully you can just see that just simple moving average and just looking at how price reacts with them. Okay, and as always, as you hear me always say, a bit of practice, just having a good routine that gets you in the right analysis routine will invariably help you. All right, it will help put you in the right space. Okay, and that's what we like to that's what we like to see on that. So we've had, you can see just a bit of reaction there, just but also bringing into image the what we've just talked about with regards to moving averages. But the important thing is we can see is that that dollar is still sort of demonstrating an element of its strength there. Okay, and so that's what we'd be taking that on board. Even here, dollar against Swiss franc is the daily chart. Now, if I look at this on the weekly chart. These were a couple of my really good trades last year. Where this is the weekly chart. Price had been in a downtrend. Let's bring up the drawing tool, Paul. Price had been in a downtrend. It pulled back. And where did it pull back to? It pulled back to the 50-period moving average. And then here, what we had was a very clear bearish pin bar. Okay, rejection candle, and we basically pushed down for a couple of weeks, pushed back up, and then we had it again here. A very simple bearish pin bar here before price pushed its way all the way down there. Okay, and that was just great examples of basically utilizing that 50-period moving average. It is basically seeing that as dynamic resistance pricing. And when I remember what I was saying, confluence of events, 2, 3, 4 things all come together, time and place. That's your trade. Away you go. And interesting, if you look at where we finished last week, we pushed up to the 50 and we've closed beneath it. Okay, it's not as clear cut as these very nice bearish pin bars, but there's certainly, see how it reacted. It couldn't go up and close above the 50. And if you look at that, that was the last week there. That was the last week there where we actually closed above the 50, and so that was back in September. So we're getting towards like 5-6 months of price being beneath the 50, and we're back up here. Okay, and now you'd be looking at, well, is history going to repeat itself? Is it going to bounce its way off there and fall its way over? And that's what I'll be kind of watching on dollar Swiss over the next couple of days and weeks with that. So, as I said, you can see there are plenty going on there with regards to A, dollar strength, and B, also how moving averages can help you analyze those markets and also give you locations for actually to join the trend. That's ultimately what we want to be doing. Let's have a little look at the indices. Okay, as I said, President's Day, so there's not going to be much intraday going on. All right, okay, not really massively. But if we look at Bosch, the Dow, okay, what we have here, the Dow, is you can see the weekly chart has just been in a fabulous trend there, isn't it? It's pulled away from the moving averages, and this is another way that is useful. Is that when price starts going, really in a real strong vertical path move and pulls away from the moving averages, that's a fabulous move, but it generally is not sustainable. And what we see is we get up and then we sort of get a comeback towards the moving averages, or we go slopes downwards, waiting for the moving averages to catch up. And I'd say that's what we're looking at a little bit there. But when we go down to the daily chart, you can see how from, once again, if you'd have been trading that breakout of that square there, okay, and price beneath the red 50-period moving average, you would still be in that trade, okay, as the price has worked its way up there. We've come back to the 20, but actually, we've reversed off this kind of zone between the 20 and 50 and carried on. And we can see here there was support on that. Now I'd be wanting to see, does it have the strength to continue higher up, or will it just basically sort of reverse and roll off that, which would be kind of interesting to see. I think maybe we'll get a quiet-ish week, and then invariably what we'll see is that as the FOMC minutes come out, that might be provide us with the let's say the sort of the juice to basically get those markets flying high, which is I think is what they will do. The same here, the Nasdaq on the 20 against the sort of the daily chart Nasdaq. We can see here that, the 20 had crossed the 50, but even, if this is where the cross is, you'd be buying here. Now, of course, it has gone up beautifully, but when you're buying there, you're a long way from those moving averages. So if you used, if you had a stop beneath the 50, yes, you'd be in a very happy uptrend, but also what you'd realize is that, your trade risk, the difference from price you've entered and where your stop loss would be, considerable. So in trying to achieve a good, healthy reward to risk on your trade, you'd be out of bounds there in terms of, the way that particularly looks to move its way up. Okay there, ladies and gentlemen. Well, as I say, time flies when you're having fun. So we'll have to draw it to a close there this afternoon, ladies and gentlemen. But I hope you found that useful. I hope that's given you a bit of insight into various different ways that you can use moving averages and actually how they can be helpful to you as a trader. I hope you have yourself a fabulous trading week, ladies and gentlemen. And, as I said, if you're in the London area on the Friday, 8th of March, ActivTrades are sponsoring the London Trader Show. So come along and see me and see the rest of Vikesh and the team there. Okay, you'd be very, very welcome. Alternatively, I hope to see you next Monday when we'll talk about which asset class we should focus on trading. Have a great trading week, everybody, and I'll speak to you soon. Thanks.